Welcome back to another episode of Palisade Radio. I'm your host, Karema Mutlu, and on today's show, we welcome Gwen Preston, who's the founder and publisher at resourcemaven.ca. Welcome to the show, Gwen.
Thank you so much for having me.
So far this year, gold has done very well, while the US dollar has remained relatively strong at the same time. So if gold is able to push higher later this year, Gwen, with $1,400 perhaps acting as a new base, will it need the US dollar to roll over, or are the other fundamentals that are positive for gold, inverted yield curves, interest rate cuts and negative bonds, are they enough of a driver going forward? And would you say that those fundamentals have put a floor on the current gold price?
You've basically captured all of the major questions around gold in one question. So maybe the rest of the interview will just be me answering this one question. At the end of the day, obviously it's easier for gold to gain when the US dollar is moving in the opposite direction, but it's not necessary. And as we went through this long, drawn-out gold bear market, there was lots of conversation about how what we needed was two things: for the stock market to roll over and for the US dollar to roll over. Those were the things that we needed for gold to go. That is no longer really the case. So, and we're talking about the US dollar. Of course, currencies are all a relative game. What's really going on in the currency world right now is a race to the bottom. Global central banks are cutting interest rates everywhere, and everyone's trying to cheapen their currency because global trade is weakening. So if you have a cheaper currency, you are more attractive to pull in the trade that does remain. So everybody wants a weaker currency. The problem is we can't all go down. It's like I say, currencies are relative, so there has to be a strong counterpoint to those downward trending currencies. So the US dollar is that counterpoint. It is what it is. I feel that the other factors propelling gold that you listed there are clearly more important at this point. So the other factors that are propelling gold are, like you say, interest rates that are falling, bond yields that are negative, uncertainty across a broad spectrum of what investors care about, from trade deals through to Hong Kong unrest through to the stock market. There's a whole lot of uncertainty. All of these forces are more important, and they are driving what I call sort of a new kind of safe haven trade. The safe haven trade was always buying bonds, but we can talk about this more, I'm sure, down the road. Bonds are a pretty messed up place right now, and so when investors start looking for the safe haven, gold really steps forward in a more clear way than it ever has before in this kind of situation. So long story short, gold can perform and is performing already against a strong US dollar. When gold performs against a strong US dollar, it is the mark of a real gold bull market. So I think that is something to grant a lot of confidence to gold's move so far. I'm not a chart person, a technical analyst, but I did spend a fair bit of time actually looking at gold's chart just yesterday. I mean, it is a very nice looking chart. I don't know exactly where to draw the lines, but I don't think there's a lot of downside for gold. No ascent is without pause. So of course gold is going to have its downs as this bull market gets going. But would it go back below 1400? I find that unlikely. Never say never. Like I say, I'm not a chartist, but I really think that the fundamentals propelling this market are really outstanding.
Excellent. Okay, it would be great to understand how the sentiment at the recent Metal Investors Forum was like for you, Gwen. In your view, are investors and institutions still cautious around the precious metals, even at $1,500 gold? And we talked before the call about cannabis investors perhaps rotating into the precious metals sector. Can you talk a little bit about that?
Yeah, so September is a busy conference month for those of us in the gold space. I'm part of a conference called the Metals Investor Forum that happens here in Vancouver that I co-host with several other newsletter writers. Then there's Beaver Creek that's in Colorado, and then a few days later there's the Denver Gold Show. So it's a very busy conferencing few weeks. Let's start at the Metals Investor Forum in the last part of your question, which was about marijuana investors. Over the last few years, one of the most common comments from those of us in the gold space has been, if only we could attract some of those marijuana dollars to come into our space, that would provide us with the capital that we're so lacking. And it's true. And it's especially true because the investors who moved into the marijuana opportunities are risk takers, right? That was the risk capital, and it went somewhere else. And so the fact that that risk capital was not present here in Canada in 2016, 2017, because of it being attracted over to marijuana, that had a significant impact. But what I think is so interesting now is, just as gold's fundamentals are becoming really strong, the marijuana market has topped, has turned down. There's a lot more questions. Perhaps that initial surge of opportunity seems to be done. And so those dollars are showing up. I found it really interesting and heartening at my conference, walking around, chatting to attendees. There were at least half a dozen people who in conversation, they on their own brought up that they're new to metals investing, but they see opportunity in gold broadly. So they're here to learn about how they might take action on that. And they specifically have marijuana dollars burning a hole in their pocket. And I kept smiling to myself, thinking, this is literally the person that we've all been waiting for in this sector for the last few years. So that is happening. So that's helpful. What a gold bull market really needs, though, is generalist dollars on a broad scale, not simply from risk takers who were in cannabis and are looking to rotate. That's part of it, but they are part of a bigger picture. So even right now, you can look at the price of gold, you can look at fund flows into gold, physical gold-backed ETFs, and the price and the funds into physical exposure have been climbing and climbing and climbing since this gold move started in the middle of the summer. But fund flows into mining stocks haven't actually increased that much. Yes, we've seen some nice returns for sure from the major producers. You see in the Kinrosses and the Newmonts and the whatnot, up 60, 70, 80%. That's fantastic. But overall, the amount of new money that has flowed into mining stocks has still been pretty small. And that's why we have yet to see broad positive impact on the junior space. There are certainly juniors, explorers, and developers who are performing well, but they're sort of the exception rather than the rule. The rest of the juniors are still waiting for money to rotate down. And that happens when generalist dollars arrive in the space. And so when a gold bull market gets started, those of us who are really attuned to gold, really engaged gold investors, we probably have a broad portfolio, but at the beginning of a gold bull market, I am one of many who realizes that you don't need to take the super high risk opportunities at this point. There's 60, 70, 80% available by investing in Kinross. So let's do that. So a lot of us put our money into the low risk options at the beginning, into the major producers, into the royalty companies, into things like that. And that creates the first part of the lift. Then if the gold bull market is truly real, if it's truly being driven by fundamentals that involve risks rising in the general economy and investors needing safe havens, then first they turn to the gold metal, but then they start looking for equities. And so getting back to the actual question that you asked, one of the really important things that we all noticed in Beaver Creek and in Denver was the presence of generalist fund managers who have not been seen in our space for many years. JP Morgan was at the show. Goldman Sachs was at the show. These guys are walking around. They manage hundreds of billions, if not trillions of dollars, and they realize that gold is an opportunity right now. They will absolutely only put money into the lowest risk options in our space because they have things like a $1 billion minimum market cap, and there's only a few dozen companies in our entire sector that meet that, and they're the large producers and the royalty companies. But when those dollars start flowing into those initial opportunities in gold, that lets a whole bunch of gold investors who are already positioned take profits, cycle down, and put their money into the next level of speculative opportunity, and then the next after that. And so we start to see the others perform. So at the end of the day, sentiment at Beaver Creek in Denver was very positive. People are very encouraged by gold fundamentals, and the presence of these generalist fund managers really stood out. And I think bodes very well for equities in the gold space starting to catch up in performance with the gold price, which has already, of course, caught a lot of attention.
Earlier, we briefly talked about the negative yielding bonds, so it'd be interesting to talk about that in more detail. You brought up an interesting chart in a recent presentation which showed the market value of all global negative yielding bonds versus the price of gold, and the correlation between them is quite unique as they appear to match. So talk to us about this and why it's important for gold investors going forward.
Absolutely. So those of us who sort of pay attention to macroeconomics are very aware that we are in pretty strange waters right now. You never want to overuse the term uncharted waters. It's difficult. I always hesitate to say it's different this time because that is rarely actually true. But I think it actually is different this time. So I'm out on a limb and saying that. And the reason that it's different this time is that the safe haven trade is truly challenged in its conventional form. So for many years now, for going back decades now, large pools of low-risk money, the pension funds, the endowment funds, the really big pools of money, insurance dollars, they've all invested in bonds for reliable returns, right? And they look at, they have banked on 6 to 7% returns from bonds. Those don't exist anymore. In this ultra-low interest rate world that we're in, and the fact that bond yields have turned negative, a quarter of investment-grade bonds, and that's both, the majority of them are government, but it also includes $1 trillion worth of corporate bonds. A quarter of investment-grade bonds are now negative yielding. So you don't get 6 to 7%, you get charged for owning those bonds. So that's a real paradigm shift in how low-risk money, where low-risk money can sit. And so this isn't brand new. This has increased over the years, but it's not brand new. Over the last few years, a lot of the reaction to that from these fund managers for low-risk money has been to put money into the stock market. And so it's been an important force in continuing the stock market's ascent, is that low-risk money has been buying stocks because it turned out the stock market was actually a pretty low-risk, reliable, upward-marching thing. But now, all good things must come to an end, and risks are really rising in the stock market. We have all kinds of reason to be worried that a recession is around the corner. And so what are they supposed to do now with these large pools of low-risk money? Stocks are certainly still part of the equation, but they carry a lot more risk. Bonds, there's some you can own. You could play them for price rather than yield, but that's never been the actual game. That's never been the point of the low-risk bond trade. So you need a different safe haven, and gold really stands up in that equation. It has always had two knocks against it as a safe haven. The ones that always are brought up are it doesn't pay a yield. Well, these days neither do bonds, so meh. And it costs to hold. But there's been such a proliferation in the last decade, call it, of ways to get exposure to gold through physical-backed ETFs or indices of gold miners or even gold-backed cryptocurrencies. There's an abundance of ways to hold gold that doesn't have a carrying cost. So the knocks against gold as a safe haven are kind of irrelevant now, and at the same time, it is standing up as an option when the regular heart of the safe haven trade no longer stands. So I really think that the gold safe haven trade is different this time, and I think that chart that you just referenced is great evidence thereof. So that chart, like you say, just charts the increase in total value of negative yielding bonds, investment grade bonds in the world. It's currently at about $17 trillion. And the pattern that has made as it ascended, almost the price of gold matches it almost completely. It's actually an amazing chart to look at because of how close the correlation is. And so I think that just reinforces that conclusion that I've come to, which is that gold is playing a role in this negative bond yield environment that is not unique, but is much more notable, much more outstanding than it has been in previous safe haven trades. So yeah, the negative bond yield environment is a really curious beast. There's all kinds of conversation about what it will mean in the long run, but in this moment, what I think it means is that gold is a pretty safe place to be.
Fantastic. Okay, let's move on and talk about a few of the key books that have helped or guided you throughout your career to date, Gwen. What books have helped to shape your contrarian view of the markets?
It's an interesting question. So, to be honest, I'll start by sidestepping the contrarian aspect a bit and just say geology has helped me a lot. So I think one of the things that's really interesting about the gold sector is that whether you're an investor or you're an executive or you're a banker, no matter what angle you come into the market from, we all come with an area of expertise, and then we all come lacking all the other areas of expertise, right? So my background is chemistry and journalism. I'm very good at communicating, and I have a science background, but I didn't know anything when I started a decade and a half ago. I didn't know anything about the markets, and I didn't know anything about geology. And so those were the gaps that I needed to fill. And so there's been a few books that have really helped me get enough understanding of geology to be aware of red flags and questions to ask. One of them is one that's just called Mineral Exploration and Mining Essentials, sort of a very straightforward title, but it does a very good job of explaining sort of, I would describe lumping together the bodies of knowledge that are important in when you approach mineral exploration projects and trying to understand the advantages, the disadvantages, what questions to ask, things like that. Aside from that, I think I've read a lot of biographies or autobiographies of successful folks in the sector, things like David Lowell's Intrepid Explorer, right? These guys are living examples of grinding through the bear market, realizing that there's opportunity on the other side, being courageous enough to position for that opportunity, coming up with often new, clever ways of structuring deals, structuring property acquisitions, structuring companies that work out well. So I think that has really helped me, because understanding timing and understanding how companies come together and how deals influence potential for success is really essential in this space. You could describe it as a bit of a messy space in that sense, because projects get here and there, and there's royalties, and there's streams, and there's fractured land positions, and there's a huge range of share structures, and who owns what, and all these things. So I think just reading a fair number of biographies and autobiographies, stories that actually happened, people where it worked, have helped me understand the scope of these, which things have worked in the past, which haven't. And importantly, the haven't part matters, right? Lots of the people who are very successful in our space, not everything they did was a success. I think one of Ross Beattie's famous things is that he always will say that he started Pan American Silver quite a few years too early, and it came very close to going under because the silver price did not turn in the time frame that he had anticipated. Of course, it did survive and is now a great silver success story. But stories like that have really helped me especially when we're at a difficult moment in the market, where we've been for quite a while now, to see that there's opportunity and to understand that it's worth continuing to look for that opportunity and stick to what I know and what I think is exciting.
Excellent. Okay, as we begin to wrap up, Gwen, is there anything else you'd like to discuss with us today? Any other markets apart from gold and silver that look interesting and unloved to you at the moment? And also, before the call, we were talking about a new conference that you're currently going to put on.
Sure. In the unloved markets side, we shouldn't forget about the other precious metals, platinum and palladium. Palladium has, of course, gone on a very significant price run in the last few years, but there's lots of reason to believe that price is fairly well supported even at its current levels. The support for that at its current levels and the fact that platinum, by contrast, is quite weak means that I think there's some interesting opportunities in the platinum and palladium space right now. It's hard to find exposure to those, but I think platinum has price upside and palladium has sort of more long-term upside. There will always be questions about whether automakers will switch their catalytic converters back they're in palladium right now, will they go back to platinum because platinum is now the less expensive? Whichever they do, there will always be supply issues for both of them. So I think that space has some opportunity. The geology is a little more complicated, so you have to have some friends in your pocket who can help you understand the geology side of that. Nickel is also a commodity that has attracted a fair bit of attention of late. And I think there's some pretty interesting opportunities there. One aspect of that is the simple, in the last few years, we've loved to talk about energy metals. Most energy metals, battery metals, are very niche markets that are very volatile. Take vanadium, for example. It's up and down, it's left and right. It's very difficult. It's very opaque. It's very difficult to know what's going on in the vanadium market. But every battery chemistry pretty much needs a lot of nickel. So I think there's a story there that works well. Nickel's still, the amount of nickel that goes to batteries is still really small relative to what goes into steel. But I think there's a story there on the investment side that has a lot of potential. So I think nickel is also an interesting opportunity. And then you just mentioned the conference. I appreciate you giving me the chance. So I've actually just sort of pulled this together in the last 10 days. It is a conference about current opportunities to participate in financings. And I've done this, I'm putting this on for the first time here in Vancouver on October 10th because I think there's a bit of a disconnect, and it happens in two ways. First of all, retail investors go to conferences to learn about opportunities in the gold space. People on stage, people at their booths are presenting stocks as market opportunities. If a company doesn't have money and needs to finance, that's perceived as a negative because they don't have money. And fair enough, access to capital, especially in the last, call it 8 years, has been arguably the most important aspect of whether a junior company is going to survive. So I get that access to capital is important. But while we're talking about these stocks as market buys, a lot of really experienced gold investors are flitting around the conference looking for financing opportunities. I know it's what I'm doing right now. I want warrants if I'm putting my money into something. So I wanted to bridge that gap. I think it's a gap because it can be pretty overwhelming for retail investors to start participating in private placements. Straight up, the paperwork is overwhelming. The accredited investor requirements are confusing. If you're an online trader, can you do it through your online account? Do you need a full service broker? How does it all logistically work? I totally understand that it's overwhelming, and so I've spent some time in my newsletter going through physically how you do it, and then talking about the advantages and disadvantages of participating in private placements. So one of the reasons for the conference is simply to create a venue where retail investors can learn more about how to participate in private placements, and then can be presented with 8, if that's how many companies we end up having, opportunities, 8 companies that are currently raising money. So really, at the end of the day, my business is about communicating to my subscribers what it is that I'm doing in the market right now. So what I think about gold, what I think about certain stocks, whether I'm buying them, selling them, averaging down, buying more, whatever it might be. But while I certainly do that, it would be false of me to not also communicate that I am actively searching for private placements. And private placements right now, the range is broad. I'm looking for really cheap explorers, tiny market caps, good projects, good people, but they haven't had access to capital for a while, so they're still really cheap. I'm looking for those guys. All the way through to the private company that has a massive historic gold mine somewhere, and they're just about to take that company public, but they're doing a financing round before they do so. So the whole range of opportunities. Private placements with warrants are a key way of amplifying your potential for upside in this market. And so I want to have a space where we can talk about that, and companies that we can consider if that's something that an investor is interested in. So that's my small pitch. If you are interested, the link, like I say, this is a brand new thing. The link will very soon be up on my website to sign up for that conference, and my website is resourcemaven.ca. So if you're interested, it will be in Vancouver. You will have to physically be present, but that's happening in not too long.
Fantastic. Okay, thanks again, Gwen. It's been a pleasure having you on the show.
Thank you so much.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip-your-face-off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?